Many of you would have wondered how to predict the future performance of large cap funds. Industry expert Mr. Hariharan will share his insights with you now.
So one is to look at what has been the historical performance, and within historical, it's important to look at what is called as a rolling return. So there are two types of return that typically is available. One is a generalized absolute return versus a CAGR returns. The other thing is a rolling return. What a rolling return does is that it captures multiple data points. So for example, if I were to look at a last 10-year performance of a large cap fund today, I will take the NAV of today, compare it with the NAV 10 years back, and I will say that in 10 years, this fund has delivered so much of percentage, which is what is normally referred to as the CAGR returns, okay, annual return. But that does not give a fair representation, because if my 10 years back NAV or the market was very low and today market is at high, I will find that my fund is perhaps the best fund. So to have a better representation of the market cycles and what the fund has done over the last 10 years and how it has done over across cycles, is to look at a rolling return. In a rolling return, it's calculated in a way as if you invest in this fund every day.
Thanks for your detailed explanation. Are you in search of a personal guide who can remove the stress of handling your finances? Then please feel free to avail our expert consultation. And also you can attend our webinars to gain investment related insights. Both the consultation and webinar are absolutely free, and you can find the link in the below description. Please like and share, and do subscribe to Holistic Investment.
So all those 10-year data points will be captured, and then you average it out. So it is a better representation, because you are not dealing with just two data, you're dealing with thousands of data, and that is a better representation of how the fund has fared across different market cycles. So that's important for us, because in an upcycle, most funds will tend to do well. It's important to also look at what happens to the fund when there's a downturn. So a better representation is rolling return. So look at the rolling return of the fund. To also look at the fund house, what is the philosophy that the fund house follows? That's also an important thing to consider. There used to be a time when fund managers used to be the boss. Today, with most of the top asset management companies, it is not the case. So therefore, a particular fund manager entering or exiting may not make a significant impact on that particular scheme. But it's important to look at what are the kind of processes that the fund house follows, what are the risk mechanisms in place, and that's I think these are some of the things that one can look at.
Thanks for your detailed explanation. Are you in search of a personal guide who can remove the stress of handling your finances? Then please feel free to avail our expert consultation. And also you can attend our webinars to gain investment related insights. Both the consultation and webinar are absolutely free, and you can find the link in the below description. Please like and share, and do subscribe to Holistic Investment.